Thank you for joining us. In this event, we'll be discussing US tax filing pitfalls and solutions for expats living in the US. Firstly, a disclaimer. The information presented in this event is for educational purposes only and not intended as a solicitation for the sale or purchase of any securities, investments, investment strategies, or as legal advice. All investments involve risk, so be sure to consult with a qualified financial planner and or tax professional for implementing any of the strategies we will be discussing. So I'm joined today by 4 expat financial experts. Doug Martin is International Tax Director at MoreDM. Welcome, Doug.
Thank you. Pleasure to be here.
Doug has more than 15 years experience assisting expatriate and inpatriate individuals minimize their global tax exposure. Jeff McCann, also from MoreDM, is tax director and practice leader there. And welcome, Jeff.
Thank you, Hugo.
Jeff has 25 years of experience in international taxation with both MoreDM and previously with Deloitte. Brian Dunhill is founder of Dunhill Financial, and welcome, Brian.
Thank you, Hugo. Good to see you as always.
Dunhill Financial is a UK-based financial advisory firm for US expats and also recently launched a robo-advisor solution specially for expats in the US called DF Direct, which you can find out more about at df-direct.com. And last but no means least, Drew Warsbury is the founder of Ocean Advisors. Welcome, Drew.
Thank you, Hugo. It's always a pleasure to join you on these events.
Thank you for joining us, Drew. Drew is a certified financial planner with over 30 years of experience. He previously worked for New York Stock Exchange firms before founding Ocean Advisors. So before we dive in, please submit your questions for our experts in the Zoom Q&A function at the foot of your screen, and we'll endeavor to answer them all, time permitting. So without further ado, I'll hand over to Doug and Jeff from MoreDM to talk about US taxes for expats in the US. Over to you, Jeff and Doug.
Thank you, Hugo. Good afternoon or good evening, everybody. We're excited to be here today to talk about an exciting topic, expats in America in US tax solutions. We represent the firm MoreDM. We are located in Detroit, Houston, Miami, Dallas, London, Zurich, Charlotte, and recently added Grand Rapids. For anybody that's in around the state of Michigan, we would refer to that as the West Coast. While I normally work out of the Detroit office, we do have offices in Europe and London and Zurich, and I'm blessed to be in Zurich today, particularly because Detroit is receiving a bunch of snow at the moment. So at least I do not have to fight a snowfall for the commute home today. Slide, Doug. So our firm, MoreDM, is part of the More Global Network, which is represented in multiple countries across the world. More Global is headquartered in London also. And as a practice, we typically, we have files or client files right now in about 30 different countries on every continent represented on this this nice map. And without further ado, while the topic is extremely interesting, I have the ability to talk and make this go on for hours, and I'm sure people have busy schedules. So what I'm going to do is pass the mic over to my colleague, Doug, and he's going to take us through the presentation based on the agenda in front of you right now.
All right, thank you, Jeff. And Jeff may not have mentioned, but I'm actually in Zurich with him, and we're just on opposite ends of the office spectrum here currently right now. So here in front of you now is our agenda for the various topics that we're going to try to breeze through in about a half hour's time, to try to leave enough time at the end for any questions or any Q&A session to kind of go through any things that you might want some additional information on. So we'll start with just kind of going through the basic rules of U.S. residents and what that means when you become a U.S. resident entering the U.S. for the first time. So there's a three-pronged test here for what constitutes a resident from a U.S. point of view. It would be, a U.S. citizen, or a green card holder, which a green card holder is when you've been given proper visa status to be considered a lawful permanent resident of the United States. And the third one, which is probably what most of the individuals on the line here will fall into, would be a resident alien is the terminology. And this is an individual that would meet this test that's in front of you right now, which would be 31 days in the US in the current calendar year. And you would look over a 3-year calendar time frame to determine if you meet this formula, which is the current year, 100% of the current year days, plus 1/3 of the year prior to that, plus 1/6 of the second preceding year. And if the total of all three of those, when you add them up together, is over 183 days, the default for you would be that you would be considered a US tax resident. There's obviously there's other options if you meet this test. There is an exception, just like everything else in tax law. There's the basic rules, but then there's the exception to the rules. And there's an exception that if you do meet this 183-day test, that you have closer ties to a foreign country during the year, that you could also meet the qualification to be considered a non-resident. If you do not meet this formula for the current year of taxation that you're in the US, then the default for you would be that you would be considered a non-resident alien and taxed as a non-resident as opposed to a full year US resident. And for the rule that I just spoke about is just in relation to federal tax reporting only. As most of you probably are aware that you've entered the US, there's also several states that also have their own varying and different tax requirements and filing obligations. And so each state will have its different set of residence rules, which will typically be more facts and circumstances type test as opposed to a bright line test that like the substantial presence test that I just referred to.
And just one interesting comment there, particularly for those in the US, in your first year, it is possible to be a non-resident for federal purposes, yet a full resident for state purposes. It's also possible to be a resident in a state and also be subjected to tax in other states if you're physically traveling and working in other states, across the nation. In many states, as Doug indicated, they don't have a bright line test. They go on more of a domicile test, which is facts and circumstances and, putting together the information to determine whether it looks like you're in a fairly permanent state in a state. That doesn't necessarily mean that if you have a 2-year visa, you're not determined to be permanent in a state. They're just looking at your living arrangements, where your job is and where your family is, would be some of the most common and, the tests that hold the most weight.
So here we have a comparison of how a resident individual would be taxed. If you meet the substantial presence test, you're going to be treated as a resident from your first date of arrival in the US, and you would be taxed on a worldwide income, meaning not only the income that you earn in the US, but also anything that you earn outside of the US, any investment accounts, any stocks, bonds, anything else that you would own outside the US would technically be considered taxable in the US, along with your US source income. Married individuals are allowed to file a joint tax return with their spouses. There's a certain election that's available for that. And you're also subjected to substantial reporting regarding non-US foreign financial assets, whether that be ownership, which we'll kind of delve into those requirements in a little bit, but whether you own, have any interest in bank accounts or other foreign stocks or companies that you might own. And then obviously you have the state tax, and then you're subject to gift and estate tax rules as well. Non-residents, on the other hand, are only taxed in the US on US sourced income. An example of US source income would be if you come into the US for a short period of, let's just say 3 months, and you earn wages from an employer, that would be considered US source income. But if you're only in the US for 3 months and you also have, bank accounts outside the United States that earn interest income or dividend income, that would not be taxable for US purposes because it's not US source income. There's also certain withholding rates on any US source income. If you were to open up like a US savings account or US investment account, there's certain withholding rates required for non-residents. And then again, not only do you have to look at this from a federal standpoint, but there's also various state requirements that will need to be reviewed as well. So this next slide here.
I'm sorry, Doug, just in regards to that last slide, a few pointers. One is that there was a bullet point referred to as FIRPTA. This is a presentation really, addressing people coming into the States. But if you happen to buy a house here and you live here for a couple of years and then you leave and sell your house, FIRPTA addresses withholding requirements on gross income. And for example, if you don't sell your property at a gain, or there's special rules under, U.S. statute where you could exempt a certain amount of gains on the sale of a home. You just want to keep in the back of your mind that if you're ever selling property and you are now non-resident status, that you should address the withholding situation before it occurs, or else you're out the money and you will not receive your refund for a refund. And then just a second point is that notwithstanding all of the tax rules in the U.S., like other countries that have treaties with other nations, treaties do exist. The U.S. has a number of treaties with many countries around the world, and treaties on some occasions override domestic statute and can change the result, which is why you should always consider a qualified advisor. Go on, Doug.
Thanks, Jeff. This next slide kind of gives a brief little breakdown of the varying rates and how they're different between, and how federal and state is a little different. So there's a progressive rate schedule for federal purposes, which starts as low as 10%, and then as your income rises, you can go up to the maximum rate, which is now at 37%. And then there is a special reduced rate for long-term capital gains on stocks and other assets that you own, if you own it for a year or more. And that rate is a 20% flat rate plus a investment tax rate of 3.8%. So there is a qualified reduced rate allowed to you if you have securities and other investable assets that you own and hold for greater than a year. And there's obviously from a federal standpoint, there is also relief from double taxation through foreign tax credits. Some states also allow foreign tax credits, which we'll kind of get into what a foreign tax credit is in a little bit. But then as from a state standpoint, each state, in addition to the federal tax rate, each state has its own individual rate as well. So if you were someone that was, in the maximum rate and made a very high amount of income during the year, and you were in the 37% bracket from a federal standpoint, in addition to that, depending on what state you live in, if you're in California and you're in the highest rate in California, you would pay the 37% federal plus an additional 12.3% on the earnings on your income in California. So all in all, for a total rate, if you're someone that lives in California, you're looking at about a 50% tax rate if you were the highest, a highest income earner. And also some states, along with foreign tax credits, some states allow tax treaties as well to kind of take different positions to be able to exclude income, similar to how we can take treaties on the federal tax return. But again, it's going to be a state by state basis, and that's something that will have to be looked at individually for your situation. So now that we just have a basic overview of what makes an individual a resident, how are residents taxed versus non-residents, we're just going to touch on a few items here about the personal investment side of things and owning non-US assets. So the first slide here is about, it's talking about passive foreign investment companies, which are our investments in mutual funds or any other passive type company that meets the tests that's in front of you. The test itself isn't as important as just knowing that the regime for taxing these types of investments is quite expensive from a tax standpoint. The IRS treats these investments as if you did get a distribution in a year, and the default tax distribution for these investments is to tax it at the highest marginal rate, highest marginal bracket, dating back to each year that you originally held the asset. And then, so not only is it taxed the highest marginal rate, whether that be 37% right now, current rates, or in prior years, there was years ago in the US when the maximum federal rate was 39.6. But in addition to that, there's also an interest calculation that also increases the tax dating back to the date that your holding period began. So there can be some planning done around this and various elections available, but it's good to kind of, maybe prior to coming on the US to have a conversation to kind of determine what type of exposure there might be regarding these investments.
And this concept's referred to as PFIC. And the reason why we bring it up is that it's very common for an individual's pension or retirement plan held outside the United States to hold non-US mutual funds or CCAVs or unit trusts or some version thereof. From a US perspective, these types of investments are viewed as PFICs, which, as Doug described, has a disadvantageous tax result, because if you're not otherwise in the highest marginal rate, what happens is that when there's sales or sometimes distributions, you could end up with a throwback calculation that would subject the allocable share to the highest rate plus interest. So it actually drives the effective tax rate even higher than the highest rate. As Doug mentioned, this is an important thing to address before you become resident. And in addition to this, we mentioned treaties, and there's certain countries that are very treaty friendly with the US in terms of pension articles, and other countries that have pretty much antiquated models that don't address certain concerns. So again, just depending on which nation you've come from, when you migrated to the US, the results can be different.
So as Jeff mentioned, there are investments in pension accounts and retirement accounts that can technically meet the treatment as PFICs. But the other thing to be cognizant of as well is that, even though a distribution is coming from, if you were to take a distribution of a foreign retirement account while living in the US, depending how the treaty would view that, the distribution would also be taxable in the United States. The US qualified pension plans are allowed tax deferral in the US for basic retirement and pension plans that we put funds into. Retirement plans that are not US qualified don't get this same treatment. So retirement plans, cash value insurances, any other plan similar to that should be reviewed to determine if there's any treaty ability to defer tax when you enter the US, and to determine if there's actually any tax issues associated with having that account while living in the US. All right, so we've talked a little bit about filings, or about taxes, and now maybe you're thinking, well, what type of deadlines or what filings are necessary of me on an annual basis when coming into the US. So here's a listing of some basic tax return filing deadlines. Individual tax returns are due the due date is technically April 15th, but when April 15th falls on a weekend or a holiday, they go to the next business day. And so this year it happens to be April 17th. So you get 2 extra days to file your tax return. There is the ability to file a 6-month extension. It's automatic. That extension allows you the automatic 6 months to October 15th. and it allows you to extend the tax return filing, but it does not allow you to extend the timing for payment of any taxes that might be due with the return. If you were to pay a balance due with the return after April 17th, there would be an additional penalty and interest component of the balance due. And in addition, there is the form bank account form that I touched on a little bit earlier. Any non-US bank accounts, investment accounts that you own are required to be reported and disclosed to it's an organization separate from the IRS. And that deadline is also April 17th, and that one gives you the automatic extension till October. You'll see in a little bit that there are pretty severe penalties associated with these types of accounts if these filings are not done on time. Most state tax returns, I will say as well, are also due the same due date as individuals, but rules will have to be looked at for each state to determine if there's any special separate form necessary for some states. Some states will actually deny your extension if you do not pay the balance due with the return at the time. So not only would you have late filing penalty on top of your return, but not only would you have late payment penalty, but you'd also could be subject to late filing if your extension's disallowed. So here we'll give a list of some of the more interesting forms that we see that carry additional disclosure and additional penalty exposure. So the form 114 that I just mentioned, it's the term is an F-bar that you saw in the previous slide. This is needs to be filed if at any time during the year that you own in aggregate of all your accounts together, the maximum balance of those accounts in total were over $10,000 US. So you would have to take the maximum value of each account that you might have outside the US and report that total those up for the year, and if the aggregate of all those accounts together are over 10,000, then this reporting requirement would be necessary. So just as an example, if you have two accounts and the account has 6,000, the equivalent of $6,000 US in it, and you take the $6,000 from one account and move it to the second account, that even though that's the same amount of funds, that the maximum value of those two accounts was $6,000. The total would be over $10,000, being $12,000, and this filing would be required of you. These other forms that are listed are dealing with ownership in foreign trusts or foreign gifts, ownership of interests in non-US companies, non-US corporations, which is the form 5471. The 8865 is for if you have ownership of any foreign partnerships. And then the 8621 form is the one we mentioned before that kind of talks about that kind of reports income of PFIX. The thing to be cognizant of on this page is just to make sure that you're kind of going into the tax filing season eyes wide open, and trying to make sure you get a professional to kind of walk you through these various forms, because the penalty nature for not filing these forms can be quite severe.
And we mentioned in our title, certain common traps. It's important to know that, an account has a very broad definition. So with this form 114, it's not just necessarily your standard checking and savings account. It could be an account holding securities. One of your pension accounts would be considered an account unless it was, an employer pension, a defined benefit plan. So most of your pensions will fall under this. Cash value policies, so not uncommon in Western Europe, particularly Germany. The common retirement investment tool is basically a cash value insurance policy. So if you live to a certain age, it will start to pay out, or you can liquidate it. This is considered a foreign account. If you're from the UK, for example, an ISA would be considered a foreign account. So generally speaking, most people coming to the US that have been employed for some period of time before you came to the US, you're going to have this 114 filing requirement. We refer to it as FBAR, and also the 8938. And then just as a last final trap, this form 3520, it typically covers reporting related to foreign trusts, whether you're the owner of one or the beneficiary. But there's also a provision where if you receive a gift from a non-resident exceeding $100,000, that would be a reportable event on this form. So as an example, you move to the States, you fall in love, you end up getting married, and your loving parents, say, for example, give you a couple $100,000 to buy a house. That becomes not a taxable event, but a reportable event that could carry considerable penalties if you don't file the form in a timely manner.
Hey, Jeffrey, I'd like to add on there. It's not only your individual accounts, it's also corporate accounts or charitable accounts, or, if you sit on the board of a club that you have access to the bank accounts, those all have to be reported on there. So it's anything that you have access to those foreign bank accounts, not just your personal accounts.
Thank you, Brian. That's insightful. So it's, not personally owned, but if you have signature authority, so if your business or your employer sends you from Germany to the US for a couple of years and you're in a financial role and have signature authority over that company's accounts, then you would certainly fall under this reporting regime. And if otherwise, your personal bank account was only $7,000, but you have signature authority over a company account that has $500,000, it pulls everything in because, as Doug mentioned, it's all aggregated. Once you cross 10,000, everything gets reported.
The joys of not having an inflation indexed limit, it's been $10,000 since Nixon signed it into place in 1970 something. So thank you, Richard Nixon, once again.
So now you might be thinking, well, if I'm, taxed on my worldwide income, how, well, that's, and I have, investments in my home country where I originally came from, that I might be paying taxes over there on, am I going to be subject to double tax on these? And the answer is no. The US does allow for a foreign tax credit. And what the foreign tax credit does is it allows a reduction of US tax to the extent that foreign taxes are paid in relation to the foreign income that's taxable in the US. So there's a separate form that is filed with the return. It's the form 1116, and it allows a credit for taxes, income taxes, wealth taxes, and if there's some double taxation for social taxes, you can claim a credit for that as well. Any unused credits that you don't take in 1 year's return are required to be carried back 1 year, and if you can't carry it back by amending a return, those foreign tax credits do carry forward for up to 10 years. And we'll kind of touch on treaties here in the next slide, but treaties can also be utilized in some instances if domestic US statute doesn't necessarily allow something to be considered foreign source income to offset income. If you came from a country or you have income in a country that's being taxed, that the US has a treaty with, it's good to look into the treaty requirements as well to see if there's the ability to take a position to resource something foreign. So you've heard us talk about income tax treaties a lot. Well, what are they? Tax treaties, the US has tax treaties with several different countries, and what tax treaties do is they're not domestic tax statute, but it's an agreement between two countries that allows you to override statute and come to an agreement to make sure that the US and that the taxpayer is not put in a negative situation. It does help prevent or mitigate double taxation if there is income in two countries that both countries want to tax. A big one that we also see is you can also, as I had mentioned in one of the earlier slides, domestic statute has this substantial presence test that requires you to calculate your days and determine when you're a US resident. There are treaties that allow you to override that if override that section to be considered a U.S. non-resident if you meet certain qualifications. And then we just have a closing slide here that just kind of some other considerations just to be a little weary of. Jeff mentioned something earlier about, FERPTR on the sale of your house, and something to be cognizant of. There is, if you come in, if there is the ability to exclude gain for $250,000 for single individuals on the home of your primary residence if you lived in that house for 2 out of the last 5 years. So if you, let's say you moved to the US and while you're here, you still had a home back in the foreign country, your original home, you decide to sell that and you lived in that home and you meet the qualifications, it's possible that you could exclude that gain from taxation in the US. There's additional reporting in the US if you're the beneficial interest in trusts. That was one of those forms that was mentioned earlier. You're allowed to give gifts as a US person. You can give gifts to each donee of up to $17,000 in 2023. Charitable contributions, if you're over itemized deduction limits, you do get a tax benefit in the US if you make any donations to charitable organizations. As we talked about earlier, PFICs, foreign mutual funds, foreign investments, if you have them, it's good to kind of look into how to maybe plan around them, or maybe the elections available. Long-term permanent residence, the US does have if you do become a long-term permanent resident and you're thinking that you might want to get a green card, the US does have an expatriation tax if you are to get this permanent residency card and then decide to later leave the US. There are certain timeframes and parameters in relation to this, but it's something to be wary of and to kind of think about if you're looking to kind of get your permanent residency in the US. And as always, it's just always good to make sure you review the entire year's transactions, not only from a US point of view, but from a non-US point of view, just to make sure that anything is being disclosed or reported properly from an income tax and disclosure standpoint on your US filings. I see that I think we do have a couple of questions that have come through, Hugo, but.
Well, I tell you what we might do. We might go over to Drew now, who's going to say words, and then come back for questions.
Okay, great.
And Drew, I think you're going to say something about legal documentation.
Yes, thank you, Hugo. Just something I'd like to point out, because it's an exercise I go through with all my clients at the beginning of the year, make sure that we have the right legal documents in place. And for anyone here in the United States or considering moving to the United States, there are really 4 documents that I think are mandatory. Everybody should have as part of their overall financial plan, because not having these could have significant impact on you financially. And I'll start with the first one being the will. I don't think I need to spend time talking about the function of a will. We all know pretty much what a will does. One of the reasons why you want to have a will is because if you die without a will, your estate will go through probate. The downside of dying without a will, which is called intestate, the downside of dying without a will is that the state in which you have property, they have their own rules of inheritance. So the way you would normally write your own will, as far as who's going to inherit what from you, may not be the way the state interprets their inheritance laws. And so you can't control who is going to get your inheritance. So you definitely want to create your own will rather than let the state do it for you. Unfortunately, we find that like 60% of all Americans, that was a statistic I saw recently, 60% of all Americans die without a will. So we're keeping the government busy, I guess. If you want to avoid probate, and probate can be lengthy and it can be expensive. I happen to know at least 2 families who have spent over 2 years trying to get an estate settled for a family member. And these were people who got along. These were family members who got along. You can imagine if someone is going to challenge and contest the will, it could take longer. And that's what happens in the scope of a probate settlement. You can avoid that by creating a trust. And, there are all sorts of different trusts that can be created. That's a rabbit hole that I'm not going to go down right now. But just assume that you can create a trust that is going to allow you to settle an estate without going through probate. So you're going to save time, you're going to save expenses. And it's one of the advantages also is that it gives you a little bit more control about how your estate is going to be distributed, even after years after you've passed away. So you definitely want to at least have a will. That's number one. You should have a trust. Why would you have a will and a trust? Well, inevitably, things slip through the cracks. In order for something to be considered part of your trust for an estate settlement, it has to be in the name of the trust. So if I have a client with a joint account, or if I have a client with a single name account, Hugo has an account with me. Hugo has created a trust, but he hasn't shared that information with me, and we have not opened a trust account and moved all of his many millions over into the name of that trust. Then there's really no point in having that trust. Inevitably, there are going to be certain assets that have slipped through the cracks that will go through probate. So have a will, have a trust. The two other documents I think everybody should have to do with powers of attorney. The first one is going to be your durable power of attorney or financial power of attorney. What that allows you to do is name an agent who can act in your interest when you're incapacitated or unavailable to act in your own interest. Two examples I might offer you is, let's say you're over here in the United States for a couple of years working, but you have to go back to your home country for a business trip. Right around the time that you're trying to close on a real estate transaction, you're buying a house here in the United States, you'll need to name somebody to act in that capacity for you as your power of attorney. Obviously, you don't want to be flying back and forth between countries just to go through an hour-long closing in an attorney's office. So you'll want to have the power of attorney in that case. Another example is if you're incapacitated. If you've been unfortunately in an accident and you're laid up in a hospital bed, unable to do things like pay bills, pay your mortgage if you own a home, pay your rent, pay your utilities, things of that nature. You want to have somebody who you can designate as your agent to act in that capacity when you're unable to do so. The fourth and the last thing I'll leave you with is the healthcare power of attorney. Very similar to the financial or durable power of attorney. This is the person who can make the decisions when you're unable to make healthcare decisions for yourself, or you're unable to communicate those decisions for yourself. So those are the four documents that I think make the complete suite of what you need when you live in the United States. As I said earlier, maybe 60% of people die without even having a will. So unfortunately, a lot of people overlook these. I would think that as a cross-border worker or someone who has settled and retired in the United States, you definitely want to pay attention to these types of documents. You also want to pay close attention to who you're naming as either your executor or your trustees in the event of a trust, obviously, or your agents for the different powers of attorney. I have dealt with people before who have named a power of attorney for somebody who is in the military and gets stationed overseas a lot. Obviously, that doesn't make sense. For someone who's a cross-border employee, maybe you'd be inclined to name somebody who's a family member, but if they're not in the United States, it doesn't make a whole lot of sense to do that. You need somebody who's local and could be more available for you. So with that, those are really the four things that I wanted to mention as we get started with 2023. I encourage everybody to take a look. Even if you have these documents in place, go ahead and take a look, make sure they're up to date and they reflect where you are and any changes that might have happened over the last few years. So.
Thank you very much. That was excellent. Before we jump into the Q&A, I'm going to play a short video about DF Direct, the robo-advisor for expats in the US. So let me just line that up. It's a very short video. It's 1 minute. And then we'll jump into the Q&A. There it is. That's dfdirect.com, a robo-advisor solution to get started investing. If you need more sort of tailored advice, personal advice, get in touch with Drew afterwards. And of course, for tax advice, Doug and Jeff. And I'll include you'll receive everyone's contact details in an email tomorrow, or if you're watching this on YouTube, in the description below. Okay, Q&A time. We've got a few nice questions. I had some of my own as well, but let's jump into these ones from our audience. So, number one, can you add some detail to the bullet about holding foreign trusts?
I could take that, Hugo. I mean, we can certainly add a lot of details. It's a vast area of U.S. taxation, but in general, if you're considered the grantor of a foreign trust, you would have two separate filing requirements in the United States. It would be a Form 3520A and a Form 3520, because you're deemed to be the owner of those assets. And as the owner of those assets, if they're producing income, then that income should be flowing from your foreign trust to your own personal tax return. It's basically viewed as transparent to you. If on the other end of the spectrum, say you're a beneficiary of a foreign trust, then requirements, anytime you receive a distribution from a trust as a beneficiary, that is a reportable event. And depending on the nature of the trust, if it's a foreign grantor or non-grantor, there may also be an income pickup if you receive a distribution of the trust, meaning that if the trust produces a certain amount of income and you receive a distribution, that distribution basically pulls income out of the trust and onto your personal filing. It's an area that, we could talk about it for some hours, but hopefully that helps fill in the gaps just a little bit for you.
Thank you very much. Something very specific, but do you have an update on the case against the IRS that is in process regarding pension funds in Malta being treated as PFICs?
Well, it depends on the context of that question. The US and Malta came to an agreement last year where basically there were people that were not residents of Malta putting money in what they thought were pension funds in Malta. And basically the IRS, through this agreement with Malta, said, you can't do that, don't do that anymore. And if you have been doing that, you should consider going back and correcting your tax return. So this doesn't have as much to do with PFIC investments, would carry their own issues, as we discussed earlier in the presentation, as it does that you cannot rely on that treaty article to basically shield current income until some future point of distribution. There were some other issues going on with Malta. They call them like super Roth IRAs, or I think it was an Ohio plan or something like that. Interesting how Ohio got dragged into it. But this is something that the IRS discovered was occurring. I think it was usually after it ends up in the Wall Street Journal, it takes just a few weeks and there's something coming out from the IRS. And this was one of those cases where they're basically saying, don't do that.
Thank you.
Jeffrey, just really quick, out of curiosity, because to me, the PFIC aspect of that has everything to do with what you actually invested in there. So if you owned individual securities inside of those Malta trusts, then it wouldn't be a PFIC and it wouldn't be a problem. You just have to make sure that you actually declare it as a foreign grantor trust and that you're actually paying the U.S. taxes on it.
Right. The way the way the treaty was being used was to basically defer tax on certain income, and therefore whether there was PFICs in it or not, it didn't matter. We were in this deferral mode because we were covered by treaty. But as you say, Brian, you're exactly correct. If you don't get treaty protection, then basically it's viewed as a regular investment account, and whatever those attributes are, you'll be reporting that to the U.S., whether you're invested in mutual funds or outright securities or whatever the type of investment might be.
Okay, here's a question which relates, it may be about, I'll read it out, it may be about UK taxes and it may be beyond what we're covering, but question is, how easy is it to get no tax status out of the UK Inland Revenue for SSAS drawdown funds so that you only pay tax in the US with the lower tax rate?
Well, I will be the first to admit that I don't know the exact concept of that tax, But I can tell you the U.S. Internal Revenue Code defines what a tax is, and it's not as straightforward as you would think. So basically, we would look at the nature of that tax and determine if it fits into either the Internal Revenue Code or possibly the treaty. If that tax were somehow construed as a penalty, then that would not be a creditable tax. But, if it's similar to, the US, where if you take a premature distribution, you pay a 10% penalty, but the penalty is defined as a tax, then that would be a creditable tax.
That's interesting. An SSAS is, I believe, some kind of UK occupational pension. And am I right in saying that there's that may be covered in the US-UK tax treaty?
It is for the most part, and how I've mostly seen it, not being a tax professional, but just seeing a lot of things that that people associate, is that essentially the two work in conjunction. So typically on an SSAS, you'll get 25% tax free here in the UK, and the US will typically observe that under the DTA and accept that. But essentially, it needs to be tailored per individual, because we have upward limits here on the UK side, but you don't on the US side. So sometimes it can be which benefits you want to take instead of which ones you can associate. So I think it's very personalized for each individual.
Great. Okay. More UK related questions. Are there any important considerations regarding UK National Health Service pensions for those who have moved over to the UK and acquired green cards? Let's break that down. UK National Health Service pension. That's a UK government pension. And if you've moved to the UK and have a green card, are there any important considerations? I'm not sure. That may be quite general, or is that something?
I can make a general statement to the general question that the US-UK treaty and many treaties with the US address the taxation of public pensions, or basically Social Security, and the treaty will dictate which country has the taxing right. But there is a double tax mitigation mechanism there, and then there's always a special treaty article if you were receiving government pension. So for example, you worked for the military and you weren't collecting Social Security, but it was another government pension, that then a separate treaty article would apply to that.
Great, thank you. There's a question here about UK state pension. Actually, that was something I was wondering about, because I know if you're working in the US, as I understand it, correct me if I'm wrong, you're going to be paying, you're working for a US firm, you're going to be paying US Social Security contributions. And you may well, if you've come from, say, the UK or France, you may well have already made contributions in your home country or the country you came from. So what happens? You're making contributions, or you're accumulating contributions in two countries. What happens sort of down the line? I guess you can only retire in one place.
So the first aspect of it is that there is a totalization agreement between the US and the UK. In each country, what you want to look for is double taxation agreements, one for taxes, one for estate taxes, and one for Social Security, which is considered a totalization agreement. The UK and Canada with the United States have the best two. So if you live or lived in one of those two countries, you've got the easiest mark. Some other countries are not so easy. So if you're coming from Germany or Spain or Portugal, it can be a little bit of a pain, because you might be working on something that's 50 years old. Now, in that totalization agreement with the UK, there's certain aspects that are great and certain aspects that are not so great. There's a triple witching here in the UK when it comes to your state pension. And that basically comes down to them ratcheting up towards inflation. When you don't live inside of the UK any longer, so if you move to the United States and retire, you're not going to get those inflation indexes. So it might not be as worthwhile in times like this, where we see rampant inflation. Whereas I can't remember exactly what US Social Security got last year, but it was a significant increase because of those inflation increases. Just as UK pensioners got a significant increase here in the UK. So you lose that. Now, if you pay, you can top it up even if you're living outside, and you can pay in. If you're going to go back to the UK, you're going to get that inflation index. If you're not going to get that index. So it might or might not be worthwhile, dependent on your situation and where you might end up being. I.e., you want to run the calculations based on how much you've paid in, where you might end up, how much would the gap be, and therefore what would be the best option for you.
Yeah, it's as with a lot of these questions, everyone's situation is a little bit different, and you may well need, or may well be that you should seek personal advice. Another, well, a more general question I think may be relevant. So back to the slide on deadlines, and you mentioned there's a 6-month extension available if you're not ready by April 17th this year. And I think because often for expats, there's, as we've seen, there's often more forms that need filing, sort of complications we may not have expected. How do we get that extension if we need more time to file a US tax return?
So filing an extension is just, it's a one-page form with your name, address, social security number. You can mail it in by the due date of April 17th. You know, if you're using tax provider or using an online service, you can usually just do it all directly online with a couple clicks of a few buttons, but it just needs to be postmarked and submitted by the 17th of April. And like I said, the other thing to be cognizant of is it is an extension of time to file the actual tax return. It is not an extension to pay any tax that might be due with the return. So if you are thinking that I can just file an extension and just kick my obligations down the road, you might want to kind of run an analysis to see if you've got enough taxes throughout the year paid in, and that there's no balance that might be due on April 17th.
That's great. Just last couple of, I think, quick questions relating to, I think there are lots of people from the UK viewing. And are there any particular consideration for tax in relation, for US tax in relation to receiving an inheritance in the UK as a US green card holder?
I'll tie that in with a comment earlier. So it's not a tax event to receive an inheritance in the US 99% of the time. There's a special caveat with expatriation, but generally there's no tax event to receive an inheritance, whether the person's from the US or abroad. But if the person is a non-resident of the United States and you inherit more than $100,000, you do have to disclose that event on the form 3520. There's no tax result, but there could be a 25% penalty if you don't make the disclosure.
Thank you. And here's I think a question for, presumably for more DM. Does your firm have expertise in filing requirements for dual UK and US nationals?
So our firm focuses specifically on US taxation. But of course, in many countries around the world, we either have our network partners or relationships that we work with in terms of addressing tax issues on both sides of the ocean, if you will. And
but I imagine a lot of your clients have dual nationality, as it were. Yeah, so yeah, and I'm sure that's true for Drew and Brian as well. So I think the thing is, we've got lots of questions. Some of them are quite specific, and it will be beneficial to reach out to our experts, and you'll receive their details in an email tomorrow, which just leaves me to say thank you all very much to our experts and to everyone who's tuned in to watch. And our next online financial event for expats in the US is scheduled for Wednesday, May 17th, about buying real estate if you're an expat living in the US. And we'll include a registration link for that event in the email we'll send out following this, or if you're watching this on YouTube, again, check out the description below. And thank you very much. I think that's just about wraps it up.